Welcome to Trading Nation. I am Brian Sullivan. Let's jump right in and talk about how narrow this market has been in 2017 with Dennis Davitt and R.A. Wald of Harvest Volatility Advisors and also Oppenheimer. Guys, Dennis, listen, I know it sounds kind of wonky and, well, 1.5 or 1.6% range so far in 2017, but it's actually one of the narrowest markets in about 40 years. In other words, we're just not moving a lot either up or down on any given day. Does that signal anything forthcoming to you, or is maybe just calm just mean calm?
Well, oftentimes it can be referred to as calm before the storm, and a lot of times in the options market, we refer to it as a spring that just keeps getting compressed and compressed more and more. And then when you realize the movement out from that tight range, it seems that much more dramatic. One of the things we've been seeing, I mean, the VIX reflects lack of activity in the market, or I should say, the VIX reflects lack of movement in the underlying market. And we're seeing the VIX down at some pretty low levels in the 11 handles and 12 handles. And that's provided an opportunity to go out and buy some black swan or some tail risk protection. We're seeing that people buying way downside 10, 15% out of the money puts for relatively little money in the S&P. So you'll see the spider, 1 month 200 put trade for 14 cents. And it's kind of like the line in Trading Places. In South Philly, it's worth $50. Like, these are 14-cent options that people may think are expensive relative to the vol we've seen in the market, but there's still 14-cent options that people are buying a lot of.
And would you be a buyer of them?
Yeah, if I have to ensure, because think about what could happen in the next 30 days. We just had a long press conference. We're finding out more new things every single day. So we're in this compressed period, probably because people are unsure of what's going to happen. And when we get some guidance, we could see a dramatic move to the market to the downside or to the upside for that matter.
All right, Wald, when you look at this market technically, I mean, it's kind of, really flattened out in the last couple of weeks, but that is kind of a short period of time overall. Do you see a breakout coming either way eventually?
We do. I mean, right. And I guess our take is that, just because fire insurance, as Dennis was leading on to, is cheap right now, that doesn't necessarily increase the risk of an actual fire occurring. And I think that was the question you asked. I think it's just as likely that you can see this volatility occur to the upside as well, whether it's a calm before the storm or simply a pause to refresh the longer-term uptrend that's in place. And looking at this very low volatility, it's actually even started even before the start of the year. I think we've been pretty much flat for the last 6 weeks. And what that has done is allowed previously overbought conditions to recede. And even in some of our option-based sentiment indicators, speaking about the put-call ratio, from some pretty optimistic levels in early to mid-December, we're now actually getting closer towards pessimistic levels that have marked turning points over the last few years. Now, we are due for some near-term weakness. We haven't had any sort of pullback in some time, but I think just given where these indicators are, that they've already come in a bit, I think downside risk is going to be somewhat limited here. I think maybe 3% downside risk on the S&P 500. More importantly, our cyclical indicators are still very healthy. They would suggest that you want to own equities and use pullbacks, use that weakness, volatility, as opportunities to buy more.
Put-call ratio, quick, back to you, Dennis. Any thoughts on that? What Ari's just referencing? That's your world.
He's accurate on that sentiment changing, but you have to realize we saw a dramatic increase in call buying going into the end of the year out of the hedge fund community in order to try to chase return. So buying upside calls is a levered way to get long the market with limited risk to the premium. So that was a very crowded, popular trade. Now those options have since expired, and we're seeing people move back more to the traditional buying puts against their portfolios, as opposed to hedge funds trying to chase returns going into the end of the year last year.
All right, Dennis and Ari, good discussion on what has been I don't want to say a boring market, but one that sort of leaves us waiting for something. How about that? Dennis and Ari, thank you both very much. Folks, thank you for watching Trading Nation. I'm Brian Sullivan. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.